3M, a business that people in the dividend world are very familiar with, one that is now coming to light for all of the wrong reasons. Let's dive into things. 3M is a business, a conglomerate that operates in a lot of different worlds or industries. 3M owns and operates a diversified technology company that operates through four major segments: safety and industrial, transportation and electronics, healthcare, and consumer. Now, some of the businesses that you might be familiar with are these: Ace, Command, NextCare, Scotch-Brite, Post-it Scotch, Scotchgard, filters. They're right here on my notepads. They're behind me holding the things up. But this is a business that is extremely diversified with a ton of different aspects to it. And if you pause the video, you can go ahead and read here. It'll give you a really good idea of everything they do. But for people in the dividend world, they know that 3M is a king. A dividend king. They have increased their dividend now for 65 years in a row. They have paid out, obviously, a very, very long time, and currently, because of the fall in stock price, have a 4.7% dividend yield. You could see the issues with the stock price here, sitting normally around, or over the past week, about $140 or so, now falling $129.14. Why? Well, they have been in legal trouble. The company has a potential, or had a potential opportunity, to bankrupt one of its subsidiaries to sort of escape all of the financial trouble that surrounds their combat earplug lawsuits. About 230,000 of them. This is not good. Financially, this is not good via the press. This is not good at all for the business, but they were attempting this move where they take a portion, a subsidiary of 3M, they move it into bankruptcy, and essentially the brunt of the business, 3M, does not have to absorb all of this financial trouble. Now, this was blocked by a judge in Indiana, I do believe, and so for that reason, 3M now has to bear the brunt of everything that they did wrong with these earplugs. They also have been facing some previous legal trouble with PFAS, or these forever chemicals, in Belgium. This has been costing them money now for a while, and we can more clearly see this here in their actual financial statements. So if we take a look at Q2 2021, we have $2.59 of GAAP EPS. GAAP is generally accepted accounting principles, and for that reason, $2.59 is what they earned per share. Now, the company goes back in and they adjust this for other net costs of significant litigation by 16 cents, essentially saying if we did not have all of these massive amounts of litigation, we would have earned $2.75 per share. Well, come this year, Q2 2022, the business earned a whopping, and I say that very sarcastically, 14 cents. And they then tack on these special items like the combat earplugs, $1.66, or in this case, a pre-tax charge of $1.26 billion that then accounts for this $1.66 per share we're seeing down here. 51 cents for the PFAS, or the forever chemicals, and another 17 cents, up a penny from a year ago, mind you, for other significant litigations. Now, this is also an issue because including all of these adjustments, which are not generally accepted accounting principles, you now have $2.48 of EPS, which is still down from a year ago. So not only is the business and their $8.7 billion of sales down roughly 3%, but tack on all of these legal troubles. Now you could see them stashed away here on this SG&A, or Selling, General, and Administrative Expenses line. A year ago, $1.7 billion in this category. Today, or as of Q2 2022, $3 billion. I wanted to double check that I was seeing things right, so I went ahead and searched it up, and yes, litigation can be included in SG&A, and for that reason, they come out of the quarter with $110 million in operating income versus the nearly $2 billion they had a year ago. This is a massive problem. Why? Well, if this was a one-off thing, I would say don't worry about it. They had a lot of different aspects going on with their business. They're bound to fumble somewhere, but that's not the case. This business has now continued to show they're getting themselves into legal trouble, and they need to settle things quickly and fairly while also trying to grow in the future, spend on research and development so they can grow in the future, and continue to pay their dividend because investors have come to expect something from them with 65 straight years of increases. So they're growing their dividend, they're being consistent with their dividend, they need to grow in the future, they have to spend on R&D to grow in the future, and they need to quickly and fairly settle these things. Being pulled in multiple different directions is not good for this business. And all the while staying out of legal trouble because clearly it is costing them a lot. And as a dividend investor, someone who likes cash flows, I like big earnings, I like guaranteed massive amounts of income where I can be paid out the dividends. It's the reason why I'm investing in your business. This does not guarantee that. If they continue along this line, or they continue to increase the amount of money they're going to potentially have to pay to people because they're not settling quickly, they're not settling and deciding this, we see here the number could grow to, well, experts estimate it could grow to potentially billions of dollars. The number I spotted was roughly, here it is, settlements could cost more than $10 billion. May I remind you, this was a $1.2 billion charge which affected EPS $1.66. A $10 billion charge, or $10 billion over any amount of time, is not a good thing. And so for that reason, they're now being tugged in 4 different directions, maybe 5, 6 different directions, and investors are not happy, thus the steep fall off in stock price. I wanted to ask some people in the community what they were thinking. Dividend Stockpile, or Jeremy on Twitter, and Dividend Growth Income both replied. Jeremy said, I plan on not reinvesting the dividends and will look to exit altogether if the price comes back. Just too much risk, not enough reward. Sad, really. And Dividend Growth Income said, the litigation is a huge cloud over the business. I agree. Glad I've not been in this one. The numbers being thrown around are pretty scary. Staying on the sidelines, but I do think it's undervalued today. And I even went in and added, looks like future growth isn't guaranteed as well, harping on that 3% year-over-year decline. And I don't know. I mean, this is one now I'm kind of getting here to my personal beliefs, asking you, the audience, what do I do with this position? If you paused and read my Twitter replies, I mentioned I am potentially thinking of exiting this business altogether as well. 3M is included in SCHD. I have a small percentage allocated within FISROX. It is not a position that I need to continue to have direct exposure from. I will say it might be something that if 3M continues to figure things out, sort everything that needs to be sorted, take some short-term hits, this could be a really good chance to dollar cost average into the position, get in really, really low, ride the dividend yield up as they continue to grow the dividend, and just make a good chunk of money from this. I mean, buying in at $126 a share, if they return to the $250 they were previously at, which is at this point over double, given the fact that they have to navigate all these legal troubles and such, I'm not quite sure when that could even happen, if even possible. But there's a lot to think about with this. So I want to know your thoughts down below in the comments. Go ahead, comment what I should do with my 3M position. I want to hear your opinion. Maybe we'll go over them in a future video, and I will make a decision at some point on this. So comment down below, hit that like button if you did enjoy this video. Thank you very much for watching. Hope you learned something new. Hope you'll return for a new video sometime soon.